Welcome back to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm really pleased to have David Jensen with me once again. Thanks for joining me today, David.
Good morning, Jay.
Good to have you with me as always. We like to talk about the metals markets, the shenanigans that are being played, or at least appear to be being played in the markets. Let's start out with the Shanghai Gold Exchange and the Shanghai Metal Exchange. Physical metals, we're seeing a premium in various metals, and let's start out with gold. What are you seeing there?
Gold today is trading at about a $9.80 premium in Shanghai versus the LBMA price. So that's about a 0.8% premium, and that's up from a 0.2% premium last week.
Mm-hmm. Well, it doesn't seem to be terribly out of line with what the quoted price is in New York and London, but we do see quite a difference, though, when it comes to silver, a big difference, in fact. We're looking at an 11.4% premium in silver. Is that right?
Yes, it's up over $2 now. Just a note there, Jay, on the difference between London. I mean, London is showing the GOFO at 0.094% today, and it is increasing, which indicates an increasing availability of gold. And yet at the same time in Shanghai, the premium, which is indicating a shortage of gold, is increasing. The transit time is quite short from London to Shanghai, and it costs a couple of dollars an ounce to move gold between major centers. So we'll see how this continues, but there's been questioning now about the GOFO rate. Everything else in London has been questioning the gold, the silver, platinum, and palladium fixes. All four of those are going to be revamped now. And now the question has been raised by Koos Jansen today about, well, what about the GOFO? How real a number is that? So I really prefer to follow these Asian gold markets and the premia that are being generated there for the actual physical metal, because I think that's a much better indicator for us in terms of demand. So circling back to your note about your question there about silver, yeah, we're at 11.4% premium this week versus 9.3% last week. So that continues up from 2% at the beginning of July.
Yeah,
We're now over 11% premium, and palladium and platinum as well.
Yeah, palladium looking at 18.2%. That's just a huge difference of $159.58 that is being paid for the actual metal as opposed to the paper markets, right?
Yes, and platinum is about 7.4%, so about $103. So, I mean, these metals should be brought in versus the unofficial market, or what people call smuggling. There is a 17% VAT tax on these metals in China, but we know that with China and with India as an example as well, that they tried to put in some prohibitive restrictions on the importation of gold. And it just led to an explosion in demand of silver, and it led to all the gold being imported by smugglers. So I think these premia that we are seeing are really good indicators of increasing stress in the market. And today it's September 8th, Monday, and we see collapsing prices in London and New York. At the same time that we see surging physical premia in Shanghai, and those numbers, they don't really comport with one another.
Yeah, let's refresh our memories on the difference between the LBMA and the COMEX on the Anglo-American empire side of the equation, and then look at the Shanghai markets, which are real, true physical markets. Isn't that right? If I understand correctly, that you need, if you're going to sell some gold, you need to deposit it?
That's correct. On the Shanghai Gold Exchange, if you're trading gold and silver, you have to deposit a bar first to write a contract. So these exchanges that set the spot price in China are actually based upon metal transactions. And the Shanghai Metal Exchange as well, the prices there represent actual trading of physical metal, buying and selling of metal, and that's what they base their price structure on there as well.
Yeah, whereas in the New York markets and the London markets, it's really more of a BS market, frankly. I mean, it's like it's just a huge paper market of 100 to 1. So there's very little metal that actually gets exchanged, and we see at certain times of the day, which is really really remarkable, I think, David. You'll see at certain times of the day, a lot of times when the markets are not very liquid, a huge amount of selling that comes in to knock a price down, and very often it seems to be exactly at the time when intuitively you would think gold would rise. So it's like almost to discourage anybody from thinking in terms of an alternative to the dollar or to other paper money, I guess.
Yeah, that was the basis of Dimitri Speck's statistical analysis of the London gold and silver trading patterns, and he found very definitive and statistically significant deviations in the price of silver and gold, especially approaching the daily fix, which was the daily price setting. So. You can argue as you wish about whether you think it's possible or not, but we have to really look at the statistics. And these are statistics generated over 10 years plus, and the daily trading patterns. Those types of patterns don't exist unless there is indeed a pattern there.
Yeah, and you mentioned smuggling in terms of some of these metals into China. I think in your notes to me you talked about 40% of China's 1.8 million ounces of palladium consumption are actually produced, I guess, or actually come through the normal channels. So that suggests that there's 60% that's coming through unofficial channels into China when it comes to palladium, which of course is a metal that has to be had for the manufacturing of cars.
Yeah, the gap is, it's uncertain why that gap exists, but, let's just think about the amount of scrap metal moving into China every day by freighter, and it doesn't take much to put a pallet of gold, silver, platinum, or palladium in a freighter and cover it up with scrap, and, the metal is in country. So, you're not going to go digging through these scrap piles to try to find every bar of metal that there is. So I think that the fact that there is a very lively alternative market or smuggled market in China, as we know there is in India, and we know the difficulty they've had in terms of controlling metal importation there. It's a fact. So I think we just deal with these numbers and track the physical inventories and the price premia, and it gives us a sense of where things are going.
Give us some sense of the switching to India. They have a 10% VAT tax, I think, on that. But they're 22% premium on silver, I think you mentioned. So that still suggests that the Indians are paying an awful lot more than the quoted price in the West for their silver.
Yes, these are Koos's numbers again. He's dug them out, and Nick Laird at ShareLinks has put together the graphs, and they're running at about 22% premium, including the 10% VAT tax in India. And the thing was really interesting was that through the end of May this year, that the implied importation rate of silver into India was about 6,100 tons. Mm-hmm. And that compares to a global annual production of about 30,000 tons. 6,100 versus 30. So you got about 20% of the world's silver production is consumed in India, and then another 9,000 tons that's consumed in China. So China and India alone account for 50% plus of the world's silver production. So these are the markets that we really have to focus in on a daily basis in terms of getting a sense of where things are. As opposed to, I think, London, where they have what they call the local London gold and local London silver price. And I mean, looking at they're trading 50,000 tons of silver a day in London versus annual production of 30,000 tons. I mean, these numbers are the numbers really are local, right?
Yeah,
it's quite a felicitous choice of name that they've used there in London for naming their daily fix, because these are local fixes.
Yeah, these are definitely fixes, all right.
Yeah,
they're fixed. We've fixed the markets, and all right. Well, so silver. I guess your idea still is that ultimately, whereas we're seeing the biggest premiums, the biggest premia in metals that are in small supply. So starting with platinum and palladium, and silver less. It has more supply. So gold, there's more gold than the other metals, and that's why you think there's still enough physical around to keep the con game, the paper game, believable?
It's in above ground stocks in official sector hands. I mean,
Yeah.
that's the key.
Hmm.
And the official sector being the regulators, and instead of regulating the markets are not interfered with. It appears that with the BIS and the central banks and the various monetary authorities that they are regulating them in a way that controls the price. So platinum and palladium, there are inventories roughly equal to a year's demand. And in silver, it's uncertain, but we can see there's less than a year's demand of silver in above ground stockpiles, and we can see the increasing stress. So I think the Shanghai premia that we see on platinum, palladium, and silver are good indications of true metal availability to market. These large premia in Shanghai, especially on palladium, have existed for several months, and it doesn't take more than a week to move metal into that market if you're in a hurry to do so, to take advantage of the premium. So we'll have to I think we just keep tracking that.
Yeah, we certainly should keep tracking it. I can't help but think now as you talk about the availability and above ground availability. It wasn't that long ago in which I believe Goldman Sachs got its hands on some gold from Ecuador. And I'm thinking that while it may not be an awful lot of gold, it doesn't take much if you're doing 100 to 1, and if you can satisfy, if you can just keep people from wanting to take physical, if you can keep the masses of people disinterested in taking physical and believing in the paper, in the fiat currency scheme, then you don't need very much gold to keep the game going a little while longer. All you have to do is deliver occasionally when some nut wants to take actual gold, right?
Yeah, the large funds that play in the space, as it were, they're not interested in physical. They just want their quarterly bonuses, and they trade the patterns of the paper price. So they are price followers, as the majority of North American and to some extent European investors appear to be as well. But in Asia, I think they know the game over centuries, and they just want the metal.
You sent along a very interesting note to me from, I guess it was taken from Ferdinand Lipp's book, Gold Wars, The Battle Against Sound Money is Seen from a Swiss Perspective. And it involves J. Aron and Company. J. Aron and Company was a company I know that was acquired by Goldman Sachs. We know Jeffrey Christian, who's been, well, I've never had Jeffrey on this show, actually. I've interviewed him in my newsletter. Jeffrey Christian at one time worked at J. Aron and then worked and reported to Robert Rubin at Goldman Sachs after Goldman Sachs took over, and now Jeffrey has gone his own way and has his own company basically that is in the metal space and does various things. But talk to us a little bit about J. Aron and how it comes into play, and how important it was actually for Goldman Sachs to pick up J. Aron.
Yeah, J. Aron, maybe back up 1 second. Ferdinand Lips himself, he was a banker for the Rothschilds until the late 1980s, and then he quit and started his own bank in Switzerland, and then he became a lifelong advocate for sound money. And he was really a consummate gold market insider in the quiet days, and he visited J. Aron, as you say, it was purchased by Goldman Sachs in 1981. And by the way, all of the senior management of Goldman Sachs, including Lloyd Blankfein, who is today the CEO of Goldman Sachs, they all came from J. Aron as well. And so he was having discussions in the mid-90s. He said in 1996 he met with this Neil Newitt, who is a managing director of J. Aron, and Philip Culliford, who is executive director. And I really encourage people to read Ferdy's book, Ferdinand Lips's book, Gold Wars, The Battle Against Sound Money, seen from a Swiss perspective, as you said, Jay. It's available on Amazon.com, and the quote is from page 123 and 124 of Ferdy's book. But he talked about these visits and discussions that he had, and he was really confused as to why the central banks would be leasing their gold into the market and suppressing the price of their key asset. And he came to his conclusion after visiting with J. Aron that they were not just acting for central banks, but they were actually formulating the policy and advising the central banks to be leasing their gold out. And I think one thing I do disagree with is the conclusion that Ferdy has, is that they were trying to get the money or the gold leased into the market. We know how involved Barrick Gold was in that. In providing the gold in the ground so that the central banks would lease their physical gold into the market. But his conclusion was they were doing it for commissions. But I think if we look at a few $100 million of commissions versus the trillions of dollars that have really been extracted by the financial sector, and over the last couple of decades, and that's only been possible if you were able to suppress the price of gold and run loose monetary policy. It was it was the ultimate Ponzi scheme, really, that you would shut down the warning system and then run the reactor at 150% of capacity, and that's really what has happened here. So, but I do encourage people to read Ferdy's book, and as I say, it's on Amazon.com, and focus on page 123 and 124 in terms of what he was finding there. But Jay Aaron and now Goldman Sachs, who everybody's always suspicious of, but we look at Jay Aaron's role there and what a dominant force Goldman has become in the financial sector over this period of time. Robert Rubin in the early 90s was chairman of Goldman Sachs while this was occurring, and we also know that Jay Aaron was the first of the commercial banks to receive an exemption from the CFTC in the United States, the Commodities Futures Trading Commission, to speculate in commodities that it did not actually possess. And so it really looks like Jay Aaron. And by the way, there was a congressman who wanted to inquire into this in the late 90s. If indeed this was the case, and he was from the Agriculture Commission, which deals in commodities, and he asked the CFTC about this exemption that had been given to Goldman Sachs, and he was told that he could only see the exemption if Goldman Sachs agreed to it.
Wow.
So I mean, who's
in charge?
Yeah, who's controlling whom?
Yeah.
Who's regulating whom? Because it looks like the regulators themselves are being regulated by those whom they're supposed to regulate.
I just find it remarkable, David, that from a tiny company called tiny company, really, relative to what Goldman is today,
absolutely,
that Jay Aaron that so many people that have been at the top of the Goldman Sachs empire would have come from this relatively small Jay Aaron and Company. It's pretty amazing. It's
a London-based gold trader, and basically they took over. And it was, it looks like it was a coup at Goldman. I don't think that Goldman Sachs knew what they were getting into. And certainly it's been a bit of a coup for the world financial system and the world's economy because of the impact of shutting down gold and running loose monetary policy.
Well, it certainly has worked so far for the people that are printing money and stealing and robbing. If you can keep people disinterested in gold and keep them believing in paper money, and you have the printing press at your disposal, and you can create endless amounts of money, claims against real assets that you control, then you can really enrich yourself and control an awful lot of political and economic activity, I suppose. And it seems to me that so much of what's going on now has a lot to do with this very issue of what is money and who's controlling money and the monetary source of things. We talk now about a very interesting thing that's come up recently, this idea of Scottish independence, the idea that Scotland would seek to sever from the UK. Talk to us a little bit about that. When is that election going to take place, and what are the prospects, and do you think it has any significance for the markets as a whole?
Well, the referendum is on September 18th, so we're very close to it now. And there is Scotland, by the way, what I would call the continental shelf of Scotland produces about 1 million barrels of oil a day. And it's a substantial amount in terms of providing it, for the needs of the UK currently. And when you look at a map of Scotland, about 95% of the current production of the UK North Sea oil comes from an area which I think that Scotland could have a territorial claim to based on its extended continental shelf. Very interesting that September 26th is the day that the Shanghai Gold Exchange goes live with the free trade zone gold market there, where so that you can exchange Chinese yuan for gold bullion, and it really goes to maybe you can call it some kind of a gold exchange standard, not really a gold money system, but you know, the ability to exchange yuan for gold would certainly be something that would really buttress the attraction of the Chinese yuan, and I suspect that the Germans would be lined up there at the window of the first day to change some of their yuan for some of the gold that they've been unable to get back from New York.
Yeah.
So we'll see where it goes, but it's a very interesting timing there in terms of just before this system goes live, and I think that there's a real possibility that we go back to some kind of a petrogold system where, as existed in the 60s and prior, with the major producers in the world really just wanted gold. They didn't want paper for their petroleum oil that they were producing. So, you know, I think that it's interesting that Scotland doesn't, in all likelihood, have visibility of the value of its oil assets in terms of its interchangeability for gold in the future, and this ongoing accelerating trend. And I'll be following that election closely.
Yeah, it's going to be very interesting, but it seems to me the stakes would be too high for the UK to allow this election to allow Scotland to sever from the UK.
Yeah, even if they do vote for it, maybe, I don't know. We'll have to see. We'll see where things go in the Ukraine. There's a crisis being generated there by the West. You know, overthrowing the government and installing some neo-fascists in there, and we'll have to see where that all goes. And we just have to stand by. It was interesting, NATO, you know, and the role and the announcement on the weekend of imposing further sanctions on Russia, just after a ceasefire was called between Russia and Ukraine at the end of last week. So there's a real effort by the NATO countries who are all basically, or not basically, but who are bankrupt, and they're accelerating the tensions in that region. And there's the ISIS financing by the West, and the creation of that force there. They were financed and trained in Jordan by the United States.
Yeah.
And there appears to be some MI6 and some Saudi and Israeli involvement as well. So it's these are really troubling times, and the creation of trouble seems to be generated by us.
Well, I couldn't agree more. And talking to Daniel McAdams, that's certainly the consensus view. I think certainly of the Ron Paul Institute. It just doesn't make a lot of sense unless behind it all is a desire to create chaos, and from the chaos then take control. It seems to me the modus operandi of the West right now, because all the things that we're doing, you know, whether it's domestically with monetary policy that continues to create more trouble, not less, or whether it's geopolitics. I mean, wherever you go, like the Arab Spring was supposed to be a great thing. Well, whatever's taken place in wherever we've gotten involved, after that it's become problematic and more chaotic and more death and the antithesis of health and happiness and prosperity. So it doesn't make any sense unless you come back to this whole thing about who controls the wealth, who controls the ability to create wealth and create money, I should say, which is a claim against the wealth that's created by I like to say the miners, the manufacturers, the inventors, the farmers, people that actually do things. They aren't getting their fair shake, and it's a shame. But I think we keep watching it, David, and of course I think we keep watching those premia in the metals that you're talking about, because they can provide a hint, I think, of the underlying issues.
That's exactly right, Jay. I think we just stay focused on physical metal availability to market, watch metal inventories from trusted sources that are reliable, and watch those premia, especially in Asia, because they're telling us something, and they're telling us something that's diametrically opposed from a collapsing paper price that we see, in London and in New York. And there is a theory that the paper price in London and New York collapses at the end because people realize that there's nothing backing them, and those assets quickly plunge. And we'll have to see if that is the case over time. over the coming months and years. But it's it's not to be expected that you're going to have extraordinary volatility in these markets as the last of these assets get scooped away.
Yeah, well, we'll just have to keep our eye on things and do the best we can. Nobody really wants to see things fall apart. And I like to remind my listeners all the time that I'm a gold bug not because I want to get rich owning gold. I'm a gold bug because I see the underlying policies that are creating chaos and destroying markets and freedom and liberty. And so we want to exchange what is essentially worthless paper money for something that's real. Tangible, and of course things that are less liquid also that are tangible might be a good idea to own. But for first and foremost, to exchange what is intrinsically worthless paper for the intrinsic monetary metals that nature and the markets have chosen over time, gold, silver, for sure, as monetary metals. Thank you very much again, David, for being with us and bringing these very important issues to light for our listeners.
Thank you, Jay.
Folks, don't go away. I'm going to be right back in the next segment with a couple of my favorite stock picks. So I look forward to talking to you there. Don't go away.